Today, the ugly truth, the DFA Daily to the 13th of July 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour and with a touch of philosophy on the side. Before we start, a quick reminder that Veronica Morgan of Location fame will join me tomorrow evening, Tuesday at 8 p.m. Sydney, for this week's live stream, and you can ask a question live, so mark your diaries. The HIA says that new home sales have risen by 77.6% in June from a record low result in May, off the back of the government's home builder program announced at the beginning of the month. The rebound in new sales in June does not fully offset the dismal results of the preceding 3 months, and they are cautious of over-interpreting data from a single month. Well, that's good on them. It's a clear indication, though, that home builder will help protect jobs in the sector in the second half of 2020 and into 2021, they said. Additional sales data from July and August will be necessary before drawing accurate estimates on the impact of home builder on employment in the sector. New home sales data is highly responsive to changes in consumer confidence, they say, and new home sales fell to their lowest level on record in March and continue to fall in April and May. Without intervention, a significant contraction in the volume of work on the ground would have occurred in the second half of 2020, leading to a contraction across the wider economy. Up to 500,000 jobs were at risk without government intervention. So the improvements in June can be seen across all the states, which is a good indication that the home builder program is working, they said, to varying degrees in each jurisdiction. The government's announcement of the home builder program has seen confidence in the market improve. Western Australia experienced the largest improvement, with sales more than doubling during the month of June, albeit from an exceptionally low base. This is not surprising, given the state government's building bonus program, which, if combined with the first home buyer scheme, can provide support exceeding $50,000. This will create significant employment opportunities, and not just in the home building sector, they said. The cancellation rate, that's the percentage of sales cancelled during the month, remains, though, elevated at 23%, down from a peak of 30% in April, and this suggests that there are still many households that have made the decision not to proceed with a previous new home purchase in the light of the changed economic conditions. If the momentum from home builder continues, they say, we will see more slabs poured before the end of the year, protecting jobs across the economy in manufacturing, retail and professional services. But they did not publish their normal charts, and we suspect that the overall new sales figures remain way down. And of course, my question is, well, what's going to happen to existing property in the areas where new property is now being built when there's already an oversupply? And they said, across the country, Western Australia had the largest monthly increase in June compared to May, rising by 211.2%. South Australia followed, increasing by 157.1%, Victoria at 47.8% higher, Queensland at 43.2% higher, and New South Wales at 12.6%. So that tells you that not much happening in New South Wales. Now, Roy Morgan research released today said that in June, Australians expected inflation of 3.2% annually over the next 2 years. This result signified a new record low for the index, down 0.1 points on May, and a significant 0.8 points down on the pre-COVID period of February 2020. Inflation expectations have declined around the nation. However, the magnitude of the drop has been far larger in some places than others, notably Melbourne, where inflation expectations dropped 0.9% since February to only 2.8% in June. The biggest decline was seen in Tasmania, down from 4.9% in February to 2.9% in June, a drop of 2 percentage points as Hobart's formerly hot housing market has cooled during the COVID-19 pandemic. Adelaide experienced the least change, with inflation expectations of 3.7% in June, down only 0.1 percentage points since February, while expectations in Brisbane, Sydney and Perth are down by between 0.5 and 0.6%. And the ABS said that in May 2020, Australian residents returning from short-term trips overseas decreased 98.5% compared to the corresponding month of the previous year, and that was a total of 13,380 trips this month, with India as the most popular destination country, accounting for 20% of all those returning. And visitors arriving in Australia for a short-term trip in May 2020 decreased 99.5% compared to the corresponding month of the previous year reported, which makes a total of just 3,440 trips this month, with New Zealand as the largest source country, accounting for 35% of all visitor arrivals. And the AFR says retail investors bought $9 billion worth of shares since March and are largely responsible for the 30% correction in the All Ordinaries Index, while institutional investors have fled the market to the tune of $11 billion. New research by corporate advisory firm Viscerum Capital demonstrates the stark differences in investor behaviour among regular and professional investors during the coronavirus pandemic. Retail investors were found to be net buyers of $9 billion worth of equities between late February and mid-May, according to analysis of aggregate trading on popular investment platforms, including CommSec, NabTrade, Bell Direct, CMC Markets. By contrast, institutional investors, represented by aggregate trading of clients of 10 elite investment banks, including UBS, Morgan Stanley, Goldman Sachs and Macquarie, were net sellers of $11 billion worth of shares over the same period. And they concluded this was very abnormal. During the GFC, there were some similarities, but nothing like what we've seen during COVID-19 in terms of the striking difference between the two classes of investors. The behaviour comes despite many prominent fund managers and economists warning regular investors against panic selling at the outset of the crisis, instead urging them to stay the course. But they speculated the sell-off by institutional investors may have been sparked less by virus panic and more by rational concerns as they sought to free up capital to participate in the flurry of discounted equity raisings. Others may have been concerned prices were close to the top of the market. You could almost call it forced selling. We know they're trying to free up liquidity and have been facing redemptions. Understanding the psychology of retail investors buying is more difficult by comparison. And anecdotal evidence suggests a range of factors, including record unemployment and widespread work-from-home arrangements, led to a surge in new investors seeking entertainment or supplemented income, buoyed by government stimulus. Lower fees charged on retail trading platforms, including a new batch of innovative fintechs offering zero brokerage, may have also played a role as platforms such as US-based Robinhood and Australian equivalent Stake and Selfwealth experience a surge in new customers, sometimes referred to as Robinhood investors. Now, there's also suggestion that dwindling property prices may have also had a likely effect, luring real estate investors into the share markets. Others may simply have fallen victim to the fear of missing out, as the headlines have told of large winnings on offer among the capital raisings. Surveillance by the Australian Securities and Investment Commission found the market had experienced a spike of new entrants and first-time traders over the same period, with trading accounts being opened at 3.4 times the usual rate, providing further evidence of the anecdotal data offered by those commercial trading platforms. And the regulator warned in May that on a net basis, retail investors seem to be mistiming the market and rebuked the new cohort for chasing quick profits. However, several months and market rallies later, many retail investors are finding success at odds with ASIC's sober assessment. The market has recovered circa 30% since the bottom on the 23rd of March, and the retail investors seem to have timed it pretty well so far, they said. The strong support of retail investors is helping to capitalise corporates during the downturn, and it should be remembered by boards when setting terms and conditions for capital raisings. Retail shareholders as a class are probably the best investors you can have on your register. They're the ones propping up the stock price and buying and showing loyalty. They tend to buy and hold for longer periods. They're also generally more aligned to the company's vision and are more likely to accept the board's recommendations when voting. On the other hand, large institutional investors, such as the powerful industry super funds, have declared their willingness to help recapitalise corporate Australia and shore up balance sheets throughout the public health crisis. However, the data indicates that many are holding stocks for relatively short periods after participating in equity raisings. So the question is, of course, how helpful is that capital if it quickly comes back into the market and then gets picked up by retail investors? Now, we'll see, of course, whether in fact those retail investors catch a cold when the market starts to crash, as it's quite likely that it will at some point. But this is mirroring the same trends around the world, where relatively naive and inexperienced investors are being sucked into the market, whilst institutional investors are standing back and waiting for them to take the hit. So we'll see what happens. Now, while COVID-19 did not significantly affect the proportion of residential properties being resold for a profit, the full effects could be felt in the June quarter, according to new research from property research group CoreLogic, who released their latest pain and gain report for the first quarter of 2020 and reported that the portion of homes sold for a profit fell to 87.7% in the March quarter from 88.7% in the December quarter. The total value of gross profits gained from resold dwellings was down 12% from the December 2019 quarter to $19.8 billion in the March quarter, and losses totaled $908.6 million in the March quarter, up from $776 million in the December 2019 quarter. However, profits were considerably higher than the $14.3 billion recorded over March 2019, when the housing market was in a slump. Nationally, the proportion of loss-making resales inched higher over the March quarter, making up 12.3% of all resales. And the report noted that while the actual number of loss-making sales was about 4% lower over March than in the December quarter, total sales volumes fell by 11%. CoreLogic head of research, Eliza Owen, said that the increase in the portion of loss-making sales over the March quarter could not be completely attributed to the coronavirus pandemic, the associated social distancing measures, and the economic fallout of the restrictions. Despite the potential for some fallout from COVID-19 at the end of the quarter, only a small portion of the loss-making sales are a reflection of the onset of the pandemic, she said. The March quarter does not capture the full extent of decline in the property market that had resulted from COVID-19, with some of the biggest shocks to real estate transaction activity and the economy concentrated in the June quarter. In the first section of the report, the underlying transaction data shows that the proportion of loss-making sales stayed relatively steady with the onset of strict social distancing in late March. This is because the volume of sales has declined, with vendors likely to hold rather than sell in a highly uncertain economic period. CoreLogic estimates of model sales volumes revealed that there was a 32.4% decline in transaction activity in April 2020, which then recovered over May and June. Well, we'll see about that. According to Ms. Owen, this could suggest that there could be an increase in the portion of loss-making sales over the second half of 2020. However, the volume of sales activity could be more restrained as vendors were less likely to venture into the housing market during the peak of the pandemic. Ms. Owen also suggested that assistance for mortgage holders whose jobs and incomes have been affected by the pandemic, such as mortgage repayment holidays, could have contributed to keeping loss-making sales low. And across the capital cities, Darwin experienced the highest proportion of loss-making sales over the March quarter, where 50.5% of all properties were sold at a loss. Darwin also saw the largest increase in the portion of loss-making sales from December 2019, rising by 2.8%. Hobart experienced the lowest proportion of loss-making sales over the March quarter, with 97.6% of sellers making a profit on their home, while Sydney was the only other capital city to see a reduction in the portion of loss-making sales from the December 2019 quarter, declining from 7.9% to 7.6%. However, they warned that this trend in Sydney could change over 2020 amid property price declines. Dwelling values were down 0.8% in Sydney over June. This is a trend that may become more broad-based across the capital cities, as persistently high unemployment in 2020 creates a headwind for the profitability of housing, they said. And in Melbourne, while the rate of loss-making resales increased, there were 716 loss-making sales over the March quarter, compared to 904 over the December 2019 quarter. This reinforces a sense of stability that has been maintained in the housing market at a high level as a result of lower transaction activity, they said. Maintaining the stability will be dependent on the banking sector and government to extend relief of mortgage repayments and income support until the virus curve is once again flattened across the states. Melbourne dwelling values declined by 2.3% in the June quarter, while the Victorian government has imposed an extended period of lockdown in Melbourne and Victoria to combat the rise of COVID-19 cases, including banning on-site auctions and property inspections again in the hotspots. And they warned that it is highly likely that the portion of loss-making sales will increase in the metropolitan area over the coming months. And nationally, units had a higher proportion of loss-making sales at 19.8%, compared with 9.8% for house sales. The loss was more concentrated among investors at 16.8%, compared with owner-occupiers at 10.3%. And the research also found that longer hold periods were linked to higher profits from property resales. No surprise there, I guess. The typical hold period for loss-making house sales was 6.8 years, compared to 9.8 years in profitable resales. The usual hold period for loss-making units was 6.4 years, compared with 8.3 years among units that resold for a profit. And my observation is that a number of sales that are currently on the trajectory are from people who bought much more recently. So I would expect the loss rates to continue to increase. Now, ANZ announced that it will tighten its serviceability criteria for mortgage applications by lowering its debt-to-income threshold. They announced changes to the debt-to-income ratio policy for home loan applications effective for applications submitted from the 3rd of August. At present, ANZ does not accept home loan applications with a debt-to-income ratio greater than, wait for it, 9. However, the major bank has informed brokers that as of the 3rd of August, mortgage applications with a total value greater than 7 times the borrower's annual gross verified income may be deemed unacceptable for ANZ mortgage purposes and would be subject to a stricter credit criteria. ANZ is the latest lender to reverse its DTI policy, with Teachers Mutual Bank Limited reducing its threshold earlier this month from a maximum of 8 to a maximum of 7 times. These changes have come amid growing credit quality concerns linked to the economic fallout from the COVID-19 pandemic. And I have to say that 7 times is still horrendously high. When I was a mortgage banker years ago, we'd look at 3 to 4 times income. And of course, that debt to income ratio is one of the reasons why so many households are in so much debt. Now, S&P Global Ratings is forecasting an 85 basis point increase in credit losses across the Australian banking sector's loan portfolio in the 2020 financial year. The 85 basis point increase, which is expected to moderate to 50 basis points in 2021, amounts to approximately $29 billion worth in gross loans, which is nearly 6 times higher than the record low in financial year 2019. According to the ABA, COVID-induced uncertainty has pushed approximately 800,000 borrowers into loan deferral arrangements, over 61% of which are mortgage holders. Investment management firm Morgan Stanley estimates that approximately 20% of such borrowers could default on their debt, triggering a $4.3 billion rise in credit losses across the big 4 banks. The ABA recently announced that banks would extend repayment holidays for up to 4 months for distressed borrowers unable to service their loan upon the expiry of their initial deferral periods, most of which, of course, expire in September. However, Morgan Stanley analyst Richard Wiles has warned that loan deferral extensions could require a reassessment of COVID-19 overlays. He acknowledged that repayment holidays could mitigate risks to the economy by avoiding unnecessary hardship and foreclosures, but noted that they would also extend the credit loss cycle, which he said would now be more likely to peak in the second half of the financial year 2021. The analyst added that the extensions would drive higher probability of default and higher expected losses in the internal models of Australia's banks, even where default is avoided. Constraints on borrowing capacity and growing credit quality concerns have eroded demand for new housing finance over the past few months. According to the Australian Bureau of Statistics' latest lending indicators, the value of home loans approved plunged 11.6%, seasonally adjusted, to $16.4 billion in May, the largest fall in the history of the series, and that followed a 4.8% decline in April, which was the sharpest fall since May 2015. And finally, Moody's said that on the 8th of July, the Australian Prudential Regulatory Authority announced an extension of its temporary capital treatment for bank loans with coronavirus-related repayment deferrals to a maximum period of 10 months from the start of the repayment deferral, or until the 31st of March 2021, whichever comes first. APRA has allowed banks to treat loans with coronavirus-related deferred repayment as performing for regulatory capital purposes, which conserves bank capital because of the higher credit risk weights applied to impaired and restructured loans. By allowing loans with repayment deferrals to be treated as performing, banks have been given greater flexibility to manage stressed borrowers through this economic disruption, which likely will reduce ultimate credit losses for the borrowers and for banks' asset quality. Banks are less likely to foreclose on home loans or implement other aggressive efforts to extract payments from delinquent and at-risk borrowers, which should support consumer confidence and spending and avoid a potential collapse of property prices induced by widespread foreclosures, they said. The forbearance also increases banks' capacity to continue to support the economy by maintaining lending to households and businesses. As at the 31st of May, around 11% of housing loans and 18% of business loans by dollar amount have been granted a deferral, creating a significant risk to Australian banks' asset quality. Australian banks have offered up to 6-month deferrals to complement a range of government stimulus measures in response to the coronavirus outbreak. APRA's extension of existing forbearance measures highlights the significant number of borrowers that have been having financial problems during the current coronavirus-related economic disruption. The ultimate effect of disruptions from the coronavirus on asset quality will depend on many variables, including the duration and severity of the economic disruption and the effectiveness of large stimulus measures by the Government of Australia. Although they say we expect banks' asset quality to weaken, it will come off a strong base, and non-performing housing loans, which include 90-day past due loans and impaired loans, made up less than 1% of total residential mortgages before the outbreak. In the short to medium term, APRA's forbearance will provide some offset to the rise in non-performing loans and risk-weighted asset densities from weakening asset quality. However, if employment conditions remain weak, when planned deferral periods ultimately expire, there is a risk of a sharp increase in credit risk-weighted assets as borrower impairment is recognised, putting strain on bank capital ratios. Additionally, the large number of customers not able to make repayments will hurt banks' net interest margin, further straining profitability and weakening the bank's organic capital generation. Bank profitability is already being adversely affected by significant increases in credit provisions, current ultra-low interest rates, and subdued credit growth. And they said, despite our expectations for capital to weaken, Australia's banks are in a much stronger position headed into this downturn than they were during previous crises, providing significant support to their credit profiles. And bank capital has strengthened significantly since the global financial crisis back in 2008. But if you stand back and just think about all the things that we've covered today, you can see that the risks continue to run riot. And of course, remember that the virus is not under control in Victoria and is hardly under control in New South Wales. So the risks continue to build. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.